The trading floor was unusually quiet when the first alert appeared on the screens. No alarms were sounding. No executives were rushing through the glass hallways. Yet behind that calm surface, something historic was unfolding. One of the largest and most respected banks in the country had officially entered liquidation. The institution that had once been considered too strong to fall had just failed. For decades, this bank had been known as a pillar of stability. It financed infrastructure projects, backed government bonds, and held deposits for millions of families and businesses. Its advertising promised safety, reliability, and confidence in the future. It had survived recessions, market crashes, and political upheavals. Many analysts described it as systemically important, meaning its collapse could threaten the wider financial system. That reputation made what happened next even more shocking. The story did not begin with chaos. It began with silence. In the early hours of a Monday morning, international markets opened with minor turbulence. Bond yields were drifting upward. Equity markets were flat. But deep inside the banking system, settlement desks were reporting delays. Several large counterparties had refused to roll over short-term funding to this major bank. That refusal did not make headlines at first. In professional circles, it was seen as a warning flare, not yet a fire. Within hours, whispers spread across dealing rooms. The bank's overnight funding costs had jumped sharply. That meant lenders were demanding higher compensation to take the risk of lending to it, even for a single day. In modern banking, that is a dangerous signal. Institutions rely on constant access to short-term money to fund long-term assets. If that access disappears, even a large bank can be pushed to the edge within days or even hours. Executives convened emergency meetings. They reviewed internal liquidity reports showing that customer withdrawals were accelerating. Corporate clients were moving balances to other institutions. High net worth individuals were transferring millions with a few taps on their phones. Nothing illegal had happened yet, but trust was evaporating faster than any spreadsheet could measure. Regulators were already watching. Central bank supervisors had received confidential warnings from clearinghouses that the bank was failing to meet margin requirements on certain derivative positions. That meant the bank was being asked to post more collateral to back its trades. It struggled to deliver that collateral quickly enough. By midday, the crisis was no longer private. Financial news channels reported that the bank's share price had dropped more than 40% in a single session. Trading was briefly halted due to extreme volatility. Analysts tried to calm the market, insisting that the bank was well capitalized and that fears were overblown. But those reassurances rang hollow. Investors had seen this movie before. The tipping point came when the bank attempted to secure emergency funding from the interbank market and failed. Multiple institutions declined to provide liquidity. In simple terms, the bank was no longer trusted. At that moment, the regulators had a decision to make. They could allow the bank to limp forward and risk a disorderly collapse, or they could intervene immediately. They chose intervention. Late that evening, after markets closed, the financial authority released a short statement. It confirmed that the bank had been placed into resolution and that its operations would be wound down in an orderly liquidation process. Depositors were assured that insured accounts would be protected, but shareholders were warned that their equity was effectively wiped out. The phrase "they got liquidated" began trending across financial media within minutes. But something else happened at the same time, something that did not receive as much attention at first. As news of the failure spread, trading desks around the world started moving capital into assets perceived as safe havens. Among them was silver. Unlike stocks or corporate bonds, silver is a tangible asset. It does not depend on the promise of a financial institution, cannot default. For centuries, it has been viewed as a store of value during times of monetary stress. As investors tried to escape exposure to failing banks and unstable balance sheets, they turned aggressively toward precious metals. During overnight trading, silver prices surged. The jump was sudden and decisive, breaking through levels that had capped the market for months. Dealers reported shortages of physical supply in several regional markets. Futures contracts were being bid up as investors scrambled to gain exposure before prices moved even higher. This was not a speculative frenzy. It was a defensive reaction. The failure of a major bank had shaken the belief that large institutions were inherently safe. For the first time in years, investors were questioning the foundation of the modern financial system. They were not just reacting to one collapse. They were responding to the realization that the entire structure might be more fragile than anyone wanted to admit. By the end of the day, the narrative was clear. A banking giant had fallen. Markets were reeling. And silver, long overlooked, was suddenly back in the spotlight, not as a trade, but as a refuge. This was only the beginning. The morning after the liquidation announcement, the world woke up to a very different financial reality. Customers stood in quiet lines outside bank branches, not panicking, but seeking reassurance. Online banking portals were flooded with logins as people checked balances again and again, making sure their savings were still there. Trust, once damaged, does not disappear loudly. It fades silently. Inside the failed bank, teams of auditors and regulators were already at work. Their task was not to save the institution. That chapter was over. Their mission was to determine how deep the damage went and how quickly assets could be sold to cover liabilities. The language was calm, procedural, and technical, but the meaning was stark. Every loan, every bond, every investment position was now being valued not for growth, but for liquidation. As they opened the books, the story behind the collapse began to emerge. Years earlier, when interest rates were low and money was abundant, the bank had aggressively expanded its balance sheet. It bought long-term government bonds, financed commercial real estate developments, and entered into complex derivative contracts to boost profits. At the time, these moves were praised. The bank posted record earnings. Executives were rewarded. Shareholders celebrated. But the financial environment had changed. Rising interest rates reduced the market value of the bank's bond portfolio. What had once been considered a safe asset now carried hidden losses. At the same time, commercial property markets cooled, leaving many developers struggling to refinance their debts. Loan defaults crept higher, quietly eroding the bank's capital base. The real danger, however, lay in the speed of modern finance. When customers once had to physically visit a branch to withdraw money, a bank run unfolded over days or weeks. Now it could happen in minutes. A rumor on social media, a leaked memo, or a sudden downgrade by a rating agency could trigger billions in withdrawals before lunchtime. That is exactly what happened. Behind the scenes, internal reports showed that deposit outflows had reached a level that the bank's liquidity buffers could not sustain. Management had hoped the storm would pass. They believed that a few reassuring statements and a temporary credit line from a central bank facility would restore confidence. But confidence does not return on command. When the interbank market closed its doors, the bank's fate was sealed. While regulators dismantled the failed institution, global investors were processing a different message. If this bank could collapse, then no balance sheet was beyond scrutiny. Risk assessments were being rewritten in real time. Capital was flowing away from leveraged assets and into stores of value. Silver was one of the biggest beneficiaries of that shift. Precious metal dealers reported a sharp rise in orders from institutional buyers, not just retail investors. Hedge funds increased their silver exposure as part of a broader strategy to hedge against systemic risk. Pension managers, typically conservative in their asset allocations, began exploring silver as a stabilizing component within diversified portfolios. What made this movement extraordinary was its timing. This was not a period of runaway inflation or geopolitical conflict. It was a banking failure that ignited the rally. The market was signaling something profound. Faith in financial intermediaries was being replaced with demand for physical assets. On trading desks, analysts drew comparisons to past financial crises. They noted how often bank failures marked the beginning of long cycles of monetary instability. The liquidation of a single institution had become a symbol of structural weakness, not an isolated event. Meanwhile, customers of the failed bank were learning the realities of resolution procedures. Insured deposits were transferred to a bridge institution. Larger corporate accounts were subject to temporary access limits. Investment products linked to the bank were frozen pending valuation. For many, it was their first direct encounter with the mechanics of a system that had always seemed abstract as silver prices continued climbing. Financial media struggled to explain the phenomenon to a broader audience. Commentators debated whether this spike was temporary or the start of a longer trend. Some dismissed it as an overreaction. Others warned that it was a rational response to a fragile system built on confidence rather than certainty. By the close of the second day, one truth was undeniable. The liquidation of the major bank had not ended with a press release. It had triggered a reordering of priorities across the financial world. And silver, long considered a quiet metal in the shadow of gold, was beginning to tell a much louder story. By the third day after the liquidation, the crisis had evolved from shock into analysis. What had first looked like a single institutional failure was now being examined as a case study in how modern banking systems unravel. Financial conferences were hastily organized, emergency panels aired on business channels, and internal risk committees at banks around the world met behind closed doors. At the center of every discussion was one question: how did a bank of this size lose control so quickly? Investigators pieced together the timeline. It was no longer just about rising interest rates or falling asset values. The deeper issue was the structure of the bank's funding model. For years, it had relied heavily on short-term wholesale financing. Instead of depending mainly on stable household deposits, it had increasingly borrowed from money markets, hedge funds, and corporate treasuries. This provided cheap capital in good times, but it created a dangerous vulnerability. When those lenders sensed trouble, they did not wait. They simply withdrew. Internal communications, now reviewed by regulators, showed that the bank had been operating under stress for months. Liquidity buffers were repeatedly adjusted. Risk limits were quietly relaxed to maintain profitability. Executives were aware that the margin for error was shrinking, but the culture of the institution rewarded optimism, not caution. As these revelations reached the public, confidence in the wider banking sector took another hit. Regional banks saw their share prices fall. Even institutions with strong balance sheets were questioned by investors. Rating agencies began placing dozens of banks on watch lists. The language in their reports became noticeably harsher, emphasizing exposure to rate-sensitive assets and reliance on volatile funding sources. Amid this uncertainty, the silver market continued its upward trajectory. What had started as a flight to safety was now being reinforced by structural demand. Manufacturers who rely on silver for electronics and energy technologies feared supply disruptions. They accelerated procurement to lock in inventory. That industrial demand collided with investor demand, tightening the market from both sides. At commodity exchanges, traders noticed an unusual pattern. Physical silver premiums were rising faster than futures prices. This indicated that buyers were not just speculating on price movement. They wanted delivery. They wanted metal in hand. For many investors, silver offered something that bank deposits and financial instruments could not: independence from institutional risk. It did not require a counterparty. It did not depend on the solvency of a clearinghouse or the promise of a broker. It simply existed. Financial advisors began receiving calls from long-term clients who had never previously asked about precious metals. These were not day traders or speculators. They were business owners, retirees, and professionals who had watched a household name in banking disappear in less than a week. Their trust had been shaken, and they were looking for something tangible. In government circles, officials tried to contain the narrative. Press briefings emphasized that the liquidation process was orderly, that the financial system remained resilient, and that safeguards were working as intended. Technically, this was true. There was no nationwide shutdown, no frozen payment system. But emotionally, the damage was done. Public perception does not follow regulatory logic. It follows experience. People had seen a major bank fail. They had watched markets react. They had seen silver surge. And they had drawn their own conclusions about what that meant for their financial future. By the end of the week, one trend was clear. The liquidation was no longer just a corporate failure. It had become a symbol of a deeper fragility in modern finance. And silver, once again, was being treated not as a commodity, but as a form of insurance against uncertainty that no spreadsheet could fully capture. As the fourth phase of the crisis unfolded, the consequences moved beyond trading floors and regulatory offices. They reached into households, small businesses, and communities that had relied on the failed bank for everyday financial life. Thousands of employees were informed that their positions were under review. Some departments were transferred to a temporary bridge institution, while others were marked for closure. Branch managers who had spent their entire careers building trust in local communities now faced the task of explaining to customers that their bank no longer existed in the way it once did. For business owners, the situation was even more delicate. Lines of credit were frozen pending reassessment. Payroll accounts were subject to delays. Companies that had planned expansions were suddenly forced to pause operations. It was not a systemic collapse, but it was enough disruption to remind everyone that banking is not just about money. It is about continuity. The liquidation process revealed uncomfortable truths about how interconnected the financial system had become. The failed bank was not an isolated node. It was a counterparty to dozens of institutions, a lender to hundreds of firms, and a custodian of assets for thousands of investors. Each asset sale triggered a chain reaction in the market. As large blocks of bonds and loan portfolios were offered for sale, prices across those asset classes softened. Other banks were forced to mark down similar holdings, even if they had no direct exposure to the failed institution. Balance sheets across the sector weakened, not because of new losses, but because of updated valuations. This secondary shock reinforced the shift toward silver. Portfolio managers who had once treated precious metals as a niche allocation were now reconsidering their strategies. They were not abandoning traditional assets, but they were seeking balance. Silver, with its dual role as an industrial input and a store of value, offered diversification at a time when correlations between stocks, bonds, and financial instruments were rising. The psychology of the market was changing. Instead of asking how high silver could go, investors were asking how much they should hold to protect their portfolios. This subtle shift mattered. It transformed silver from a trade into a policy decision within investment firms. Once that happens, demand tends to persist. Meanwhile, political leaders entered the conversation. Parliamentary hearings were scheduled to investigate the circumstances of the bank's failure. Senior executives were called to testify. Questions were raised about risk oversight, incentive structures, and the adequacy of existing regulations. In these hearings, the term liquidation took on a human dimension. It was no longer an abstract financial process. It was about jobs lost, businesses disrupted, and communities affected. The language of balance sheets collided with the reality of everyday life. Media coverage reflected this shift. Instead of focusing solely on market charts, reporters told the stories of families who had banked there for generations, of small manufacturers who had relied on credit lines that now no longer existed. The bank had been a cornerstone of local economies, and its disappearance left a vacuum that could not be filled overnight. Through it all, the silver spike continued. Retail dealers struggled to meet demand. Waiting lists formed for certain products. Futures markets showed increased open interest, indicating that new participants were entering the space. What had begun as a reaction to a single failure was now being reinforced by structural, psychological, and political forces. By the end of this phase, the narrative had expanded far beyond the liquidation itself. It was no longer just about one bank. It was about a system under pressure, about confidence eroding, and about a quiet metal that had suddenly become a central character in a story that was still far from over. By the fifth day, the consequences of the bank's liquidation had moved from immediate disruption to systemic reflection. Analysts and economists began to map out the broader implications, examining how one institution's collapse could ripple through the entire financial landscape. The early shock had subsided, but the questions it raised were only growing louder. Inside the bank, teams continued to work around the clock to evaluate remaining assets. Every loan, investment, and derivative was being scrutinized to determine its liquidation value. Regulators emphasized transparency, ensuring that creditors and insured depositors understood the process. This was not simply a technical procedure. It was a high-stakes exercise in restoring some measure of stability to a shaken system. Meanwhile, the public's awareness of financial vulnerability increased sharply. Individuals who had never questioned the security of their deposits began asking tough questions. Small businesses, particularly those that relied on lines of credit and payroll services from the bank, faced delays and logistical headaches. Communities that had counted on the bank for decades felt a void, and local economies briefly slowed as transactions adjusted to new realities. Silver, which had surged initially as a defensive move, began to draw attention from institutional investors in a more strategic way. Hedge funds and pension managers recognized that the spike was not purely speculative. It reflected a fundamental reassessment of risk in the banking sector. Physical silver inventories tightened as demand increased, while futures markets experienced heightened volatility as traders tried to anticipate the next moves in price. Economists pointed out that this silver spike was different from previous commodity rallies. It was not driven by inflation or supply constraints alone. It was fueled by fear and uncertainty within the financial system. The collapse of a single major bank had exposed vulnerabilities in funding structures, interbank lending, and investor confidence. Silver became a proxy for security in a world where previously safe assets suddenly seemed less certain. At the same time, governments and regulators accelerated efforts to prevent contagion. Stress tests were intensified for other major banks. Emergency protocols were reviewed and updated. Policymakers emphasized that the banking system remained robust, even as individual institutions could fail. Communication strategies shifted to reassure the public, emphasizing that deposits were safe, but that vigilance was necessary. Financial media played a critical role during this phase. Coverage moved from breaking news to in-depth analysis. Experts explained how a reliance on short-term wholesale funding had amplified the bank's risk. Commentators explored the psychology of markets, noting how trust, once broken, could spread faster than any regulatory intervention. Social media amplified every nuance, with discussions ranging from practical advice on portfolio protection to philosophical debates about the stability of modern banking. By the end of the fifth day, the picture had become clearer. The bank's failure was a catalyst, not just an isolated event. It highlighted the fragility of financial networks, the speed at which confidence can erode, and the tangible value of assets outside the traditional banking system. Investors, businesses, and everyday people were now reconsidering how they measured safety and where they placed their trust. The silver spike, which had begun as a reflexive flight to security, was now part of a larger story, a realignment of perception and priorities in global finance. It underscored a fundamental truth: when confidence in institutions falters, people turn to what they perceive as reliable, tangible, and enduring. And in that moment, silver stood as both a refuge and a warning that even the mightiest institutions can fall, and the consequences are felt far beyond their own walls.